Hello financial fans, welcome back to another stock analysis. Today we'll be covering McDonald's, stock ticker MCD. McDonald's is the #1 most popular fast food chain in the world. With its 38,000 plus locations, it's present in most countries in the world besides Africa. Currently, McDonald's is sitting at a $193.6 billion market cap, and in 2021 they generated a revenue of $23.2 billion. The dividend yield is currently 2.15%. They've increased their dividends for 46 years, which makes them a dividend aristocrat. And in 4 years, if they keep increasing their dividends, they'll become a dividend king. 38% of the revenue comes from the US. 53% of the revenue from McDonald's comes from international operated markets. And the remaining 9% comes from international licensed markets. As you can see in the bottom right picture, McDonald's is present in most countries in the world, besides some in the Middle East and in Africa, being a fast food chain with the second most locations, just under Subway. To calculate the final value of McDonald's, we'll be using a margin of safety. This will be used in our final valuation. Margin of safety will be determined based on financial ratios, financial health, and the growth of McDonald's. Our standard margin of safety will be 25% and can either increase or decrease based on the ratios that we'll look at in just a moment. The steps that our margin of safety can either decrease or increase by is done by looking at the scale. When we're using 4 colors in our scale, bright red will mean 5% increase in our margin of safety, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. As you can see, the EBIT has grown from $8.5 billion in 2013 to $9.9 billion in 2021. During this period, the average growth was 9.6%, meaning no change in our margin of safety. Margin has also increased from 30.3% in 2013 to 42.5% in 2021. During this period, the average growth in margin was just under 8%, meaning a 5% deduction in a margin of safety. The next 2 ratios that we're going to look at are the dividend growth and the payout ratio. As you can see, the dividends have grown from $2.20 annually a share to $5.16 a share annually in 2021. During this period, the average dividend growth was 18%, meaning a 10% deduction from our margin of safety. As you can see, the payout ratio is currently sitting at a solid 69.5%, meaning no change in our margin of safety. The final 2 ratios that we're going to check out are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt and subtract the cash from it, then divide it by the EBITDA that McDonald's has generated. Then we get the amount of years of EBITDA that it would take to pay the entire debt. For McDonald's, this is just under 4 years, so 380% debt to EBITDA ratio, meaning a 5% increase in the margin of safety. The return on invested capital for McDonald's is 17.22%, so a 5% deduction from our margin of safety. Let's look at the valuation models next to determine the intrinsic value of McDonald's. The first valuation model that we're going to look at is the discounted cash flow model. I've imported the free cash flow all the way from 2012 to 2021. During this period, the average growth in cash flow was 9.27%. Since we're calculating a lifetime expected growth, I've this time actually gone with a higher expected growth than we see here in our average. This is because McDonald's has shown resilience throughout the years. So I'm expecting a solid 10% increase in free cash flow annually. With the 10%, we can determine the future free cash flows of McDonald's and all of the free cash flows after 2030 in our terminal valuation. To get this terminal valuation, we'll be using a perpetual growth rate of 3.5% and a discount rate of 8.5%. Summing up all of the present value of future free cash flows, we get a sum of free cash flow of $225 billion. To get our equity value, we have to add the cash and equivalents and subtract the total debt. Doing this, we get an equity value of $180.5 billion. To get a discounted cash flow price per share, we just have to divide it by the shares outstanding, which is 731.4 million shares. Doing this, we get a discounted cash flow price per share of $246.76. With the current price of $264.33, we get a downside of $17.57, which is a 6.65% downside. The next model that we'll be looking at is the dividend discount model. I've imported the dividend payouts from 4 years ago to the current date. During this period, the average growth rate in dividends was 8.2%. Since we're once again projecting the expected growth rate in the future dividends, I've gone with 75% of the growth rate, seeing as McDonald's has increased their dividends for 46 consecutive years. This is a growth rate of 6.15%. In this model, we'll once again also be using an 8.5% discount rate. Doing the math, we get a discounted dividend price per share of $249.07. With again the current price of $264.33, we get a downside of $15.26, which is just under 6% downside. The last valuation model that we'll be using is the multiple valuation. By looking at peer companies of McDonald's, looking at their stock price and their earnings per share, we get an average PE multiple of the industry that McDonald's operates in. In this case, the average PE is 30.26. To get our fair value, we just have to take the average PE and multiply it by the earnings per share that McDonald's is generating. Doing this, we get a fair value of $239.96. With the current price of $264.33, here we get a downside of $24.37, which is a 9.22% downside. Let's look at the final overview of our valuation next. Looking at our final overview of our valuation, we have imported the discounted cash flow valuation, the discounted dividend price per share, and the multiple valuation price per share. Out of this, we get an average of $245.26. The margin of safety we have determined earlier by taking the standard margin of safety of 25%, adding 5% for the debt to EBITDA, deducting 5% for the margin growth, deducting 5% for the return on invested capital, and deducting 5% for the dividend growth. Out of this, we get a margin of safety of 15%, which makes the fair value come in at $208.47. With the current price of $264.33, the downside is 21.13%. If you were using no margin of safety at all, the downside would still be 7.21%. So for me, currently it's a sell. I hope you enjoyed the video. If there are any other companies that you would like to see me cover, please let me know in the comments. Thanks for watching.